Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alconin, along with Brianna Valesky, and we have an author on the line. That author is Chris Minnucci. He's the author of The Death of the Buy and Hold. But before we get carried away with that, we're going to talk to Chris and see how he's doing this morning.
Thanks for having me on, Joel.
Okay, so you wrote a book, and The Death of Buy and Hold. Now, don't want our listeners to get too excited here. Talk about why you came up with the title and tell us about the book.
Okay, well, the title is, if you take it literally, it's a little bit misleading. It's really an ironic reference to the many financial pundits who were saying that buy and hold is dead. Back during the financial crisis especially. Really the point of the book is that buy and hold is not dead. It always has been and still is, to my mind, the best strategy for amateur investors. With buy and hold, there's no need to try to figure out which way the market's going to move or which investments are going to do best over the next few months. And all the evidence, out there really shows that amateur investors aren't very good at predicting the market's future, and that they'll do better simply buying and holding an all-weather, well-diversified portfolio. And it's counterintuitive but true. It takes a lot more work and effort to be a bad investor than to be a good one.
Okay, so let's say we have some young investors here on our desk, and they're going to subscribe to the theory of buy and hold. You mentioned a diversified portfolio. How would you recommend, investing? Let's start for kids that are coming out of college and just starting to make some money for the first time.
Okay, well, one of the things that I kind of stress in the book is that you want to try to use the principle of correlation to help you to reduce volatility and also, in some cases, to increase your returns. And in the book, I talk about the concept of black belt investing, which is just my new name for an old idea. It's long been known that by adding investments that tend to go up when the stock market goes down, you can reduce your portfolio's volatility without sacrificing returns. And my little twist on that idea is that I focus on highly volatile investments to accomplish that. And I call it black belt investing because it's similar in concept to the idea behind the martial arts. So like in judo, for example, a black belt can defeat a larger, stronger opponent by using that opponent's superior weight to throw him off balance. And similarly, a black belt investor takes a highly volatile investment that has some tendency to go up when the stock market goes down and use that to reduce the overall volatility of the investor's portfolio. And here's the key: without having to give up returns in the process of doing that. So for a young investor in particular, you want to really be able to significantly outpace inflation, to get good returns out of your investments. And at the same time, you don't want to be nervous. You don't want to be, constantly selling. If the market goes down, you get nervous and you sell your stocks. You don't want to be in that position. So you want to be able to control volatility, but without having to give up returns in the process. And this is just a way of doing that.
So you talk about investing in volatile issues, and I understand your correlation. What fits that bill?
The one that I really like best is gold mining stocks or precious metal equities. And this is an asset that's really downright weird, because when you consider it in isolation, PME really is a lousy investment. For one, they're extremely volatile, much more so than the broader stock market. And also, over the long run, they tend to have lower returns than most other categories of stocks. So they're not good investments considered in isolation. But when you add them to a well-diversified portfolio of stocks and bonds, they don't behave at all the way they do when in isolation. For one, they tend to reduce the portfolio's volatility, and as you mentioned, this is because they have low correlation with the rest of the market, and that's not a huge surprise. That's something that's well known. But what's more interesting is that adding a PME mutual fund or exchange-traded fund can also raise the returns of your portfolio. And it can do this even though the long-run returns of the PME fund are typically less than the returns of the other stock funds comprising the portfolio. So you take an investment that has relatively low returns and extremely high volatility, you add it to a portfolio, and you can wind up with higher returns and less volatility, which is pretty weird. The key is that you have to rebalance the portfolio on a regular basis. And rebalancing gives you the opportunity to buy low and sell high. And that opportunity is maximized with an extremely volatile investment like PME.
PME? Is that a symbol, or is that precious metals energy?
Precious metals equities, gold mining stocks, basically.
Okay. So you bullish gold here? Are you bullish the bullion in these gold stocks? I mean, because this chart of Newmont Mining, if you look at these, do you think that what you're saying is that you're not necessarily super bullish this, but you need to have stocks like this to have a well-rounded portfolio?
Absolutely, and you don't want a lot of this. I mean, you want to add this in a relatively small quantity to a well-diversified portfolio. So maybe like 10 or 15% of the stock portion of the portfolio. No more than that.
All right, so last question for you here. With your strategy, the buy and hold, I guess you don't care if market's up here. You don't care if it corrects and pulls back because you're going to stick with your long-term theory and you're just going to buy more. I mean, is that your perspective on the markets, or do you ever sell?
No, that pretty much sums it up. I think, if you were talking about the younger investor earlier, I think, what the younger investor wants to do is, dollar cost averaging, which is a great way to, take your savings and invest it over time, take your however much percent of your income you want to save and invest it over time in the market. And using that approach, you're basically, taking the same dollar amount each week or each month, however you want to do it, and putting it into the market. And because it's the same dollar amount going in each time, you will wind up with buying more shares at lower prices than at higher prices. And so over time, you'll benefit from that, and really then, it's buy and hold. The only thing that I do recommend that you do again is rebalance on a regular basis.
Okay, all right. We've been on the line with Chris Minnucci. He's the author of The Death of Buy and Hold, giving us his strategy. Chris, thanks a lot for coming on. We hope to speak to you again soon.
Okay, thank you, Joel.